Going broke in your golden years. It's every retiree's worst nightmare. You might have to sell your home for cash, or rely on food banks and soup kitchens, or, heaven forbid, move in with your kids. You spent years trying to get them out of your house. The last thing you want is to move into their house. So here are some strategies to help you stretch the value of your investment portfolio. Tip number 1, consider a higher weighting in stocks, because a little more in equities might yield you a lot more in cold, hard cash. Here's a look at a retiree with an 80-20 portfolio worth $1 million. They followed the 4% rule by spending $40K in their first year of retirement and adjusting for inflation from there. Historically, they'd end up with an inflation-adjusted $2.1 million on average by the time they pass away at age 95. That's more than double what they started with. And it's $700K more than they'd earn with a 60-40 portfolio. That's a lot of extra wiggle room for spending in the base case. And having a bigger portfolio later in retirement might also insulate you if there's a market downturn at some point. It's one reason why Veronica Popova at Vanguard sees the 80-20 portfolio as a modern evolution of the retirement portfolio.
Retirement used to be maybe 10, 15 years. Now some retirees could live 40 years past their retirement date. And I think that's where the 60-40 does have a bit of shortfall, where having such a more conservative approach isn't going to help you reduce the risk of outliving your assets. Having a higher equity exposure is allowing you to not just maintain your assets and have that income, but also grow your assets, which is what retirees should still be doing.
Now, an 80-20 portfolio might sound pretty risky at first blush, but history suggests otherwise. Again, let's say you followed the 4% rule with a $1 million portfolio over 30 years. You'd avoid running out of money over 95% of the time. And that's been true whether stock valuations have been very low, here in light blue, or very high, here in dark red. And this is fascinating. It's actually had slightly higher odds of success than the 60-40 portfolio in most scenarios. That's why math whiz and early retiree Karsten Jeske calls it the sweet spot for asset allocation.
It's a nice compromise position where you hedge all of the extremes. So you pick a much higher bond share. You could do better in 1929, but then some of the 1960s and 70s episodes look really bad because obviously their equities were down, but bonds too. And then vice versa, if you have a much lower bond share, then you might do a little bit better in the 70s, but it would hurt you in something like the 1929 episode, where bonds were actually a pretty good diversifier.
Of course, we don't know what's going to happen in the future, but there's over 150 years of market data to suggest an 80-20 portfolio could work out just fine. It isn't for everyone, but retirees shouldn't dismiss it outright. Tip number 2, keep the size of your RRSP in check, because this account is a double-edged sword. Sure, it's great to receive tax rebates from your contributions, but you're forced to withdraw a growing percentage of its value each year once you convert it to a RIF, or Registered Retirement Income Fund. And those withdrawals are treated as fully taxable income. So a large RRSP likely means a hefty tax bill each year in retirement. And that's especially true if your RIF continues to grow more than the minimum withdrawals. You could potentially get hit with a larger and larger tax bill for many years. And that could put income-tested benefits like old age security at risk of a clawback. So here's the play. Start drawing down your RRSP before you enter retirement. That way, the mandatory minimum withdrawals will be smaller and you'll pay less in tax overall. You might also be able to put off drawing down your TFSA, letting those sweet, sweet tax-free investment returns compound for longer. And ultimately, you could end up with a lifetime tax bill that's smaller and worry less about taxes later in retirement. And let's get to tip number 3, consider delaying the start of your CPP and OAS payments. Because you add more inflation-indexed income for the rest of your life with each month you push back your start date. And that benefit compounds the longer you live. You'd receive a whopping 42% more in CPP and 36% more in OAS if you hold off until age 70. And that can take a lot of pressure off your investment portfolio. By some estimates, you'd need to earn an average real return of 5.5% per year if you start CPP at age 65 to have the same lifetime income as someone starting at age 70. And I don't know many retirees earning that sweet of a deal on their investments. One DIY investor says delaying those benefits has worked wonders for his retirement.
The math just says that we're better off with more guaranteed income indexed to inflation than we were to have more savings invested in risky assets. And in fact, when we do an analysis of how much we can safely spend, the decision to take CPP at 70 instead of 60 allows us to spend about $7,000 more per year starting right today. We're retired and we still have quite a few years to go till we're 70. So it seems counterintuitive, but we can safely spend more now because of the decision to wait till we're 70 to collect CPP.
To be sure, not everyone will be able to delay CPP and OAS for that long, or maybe at all, but you could reap huge rewards if you can bridge the gap between the start of your retirement and the start of those benefits. Leaning on early RRSP withdrawals, building a stream of dividend income, and building up a larger portfolio before you retire are just some of the ways to help you get there. So there are 3 tips to help you stretch the value of your nest egg. There are so many others to consider though, so let us know how you plan to avoid running out of money in the comments. Plus, check out TD Direct Investing on YouTube, Facebook, and Instagram for more retirement planning tips.